Go ahead. Go. You guys don't have to raise your hand or anything like that. You guys can just unmute yourselves and tell you guys and speak.
Euro USD.
All right. Let's look at Euro USD. So we were looking at. Oh, sorry. I did not see the chat there. GJ and GBUSD. Okay, I'll look at it in 1 segundo. So, when it comes to fibs, right? What are you guys' settings on fibs? And let me check. No, okay. Take a screenshot, whatever you'd like. These are my fib levels. Hold on, let me move it over. These are my fib levels. And there you go. These are my fib levels. Take a screenshot of it, doesn't matter. Just make sure you guys have these. This is what I have. Got it? Everyone got it?
Yeah.
Cool.
Yeah.
Cool. Now, how you use these? There are a couple things that these things, and I give full credit to Jim for teaching me this. Now, this was not something I invented, right? This was not some genius plan that I made from my years of experience. No, this is something that I was taught, and I'm going to teach it to you exactly how my mentor taught it to me. So he loves using fibs, right? But what he does is basically he has two things that I didn't put a screenshot. I didn't do a screenshot, but I'll pass you the screenshot later. So what happened is he has two zones, right? And we're gonna ignore these levels, these colorful levels for a little second. We're just gonna kind of go over the basic rules of what fibs are and what they do, right? Fib retracement is kind of like a universal law, and it's not only a universal law; it's a mathematical law, right? So banks can't exactly move prices from one place to another, right? Immediately, they can't exactly move. They can't exactly move price from here to here in a day, right? They can't do it. They don't have enough liquidity. Banks don't have enough liquidity. So what happens is these levels are kind of based off the liquidity of the banks, right? And they're based off of how much liquidity somebody, a bank or a group of banks can achieve before continuing their intended route, which is basically the trend, right? And like I told you guys, impulse and retracement, right? The reason why it's called Fibonacci retracement is because it's used in a way that it retraces up, right? It's used in a way that whenever you use a retracement, it is meant to kind of catch that retracement and then use it as a bit of a base. So the first thing that you guys need to know is that these levels back here are kind of used as these levels back here are kind of not, I don't personally use them that much. Yeah, thank you, Brian. And what happens is that the lowest, so you have to kind of put them from swing low to swing high, depending on the trend. And I'll go over that in 1 second. What I want to go over is kind of what each fib means, right? I don't really use these much. I just kind of I don't use them really at all. You could remove them if you'd like, but it just kind of shows like a little bit of continuation to the upside and to the downside. It's just kind of like the full thing, right? Um, However, this is what I primarily use, right? And think of this like your primary and your secondary weapon, right? So each soldier has a primary and a secondary, right? They have their secondary, which is back here, right? This is what my mentor used to call it, the secondary kill zone, right? And then you have the primary kill zone, which is right here. The primary kill zone is within your 61.8 and your 50. Right, and your 61.8 and your 50 is kind of the golden zone, right? It's kind of the zone that everybody looks at and it's like, okay, well, this is what I really like to see, right? This is kind of like the golden retracement, right? But all retracements have failures, right? So it can break through it, and if it does break through it, then okay, right? That's not a problem. Why? Because you have the secondary kill zone. If it breaks through the secondary kill zone, then you know that the trend has broken, or you put your fib wrong, right? So what happens is this, whenever you use these for take profit and stop loss, a lot of people have been asking, how do you know when to put your take profit and where to put your stop loss? Well, here's how you put it, right? Whenever you use the 61.8, right, and say you have an entry right here, say you enter right here, and of course, the numbers are going to be all out of whack. But whenever you enter right here, your position should look something like this. So say you're going short, right? This is going short because it's from swing high to swing low, right? So you enter, say, right at the 50. You enter right at the 50. Boom, right? Your stop loss should be a little bit behind the 61.8, meaning like right there. Of course, your stop loss isn't going to be 198 pips, but it's going to be, somewhere right around there, right? It's going to be somewhere right around there, right behind the 61.8. Not on it, not, just a little bit on top, kind of, give it a little bit of breathing room. And then from there, your take profit, your first take profit is going to be the 0. Oh my goodness. The first take profit is going to be the 0, right? The first take profit is going to be right here. That's going to be your first take profit. So we can kind of drop our horizontal line there. Boom. That's going to be our first take profit, right? And we can drop a little bit of a red line right here. And can have it right there. Cool. And then from there, our second take profit is going to be at the 27. And this is where these other lines come into play, guys. These other lines are something that I was taught to as Fibonacci extensions, right? And these extensions basically show how the market moves in such a way that it basically has to go through a certain series, right? Since the market is still going in impulse and retracements, right? What it's doing is that it is going in such a way that it kind of it needs to go it needs to complete its cycle, right? It needs to complete its mathematical cycle. Um, Now, all of these are affected, right, in the sense that I use them personally as take profits. So my stop loss behind the 61.8, my take profit at the 0, and at the fib extension, right? So what would you say? Some would say like, okay, well, this is another take profit. Yes and no. Personally, I don't use the 414 as a take profit. Jim does, right? My mentor does. But I personally use the negative 61.8 as my other take profit, right? And then these are just kind of other, like if it breaks through this and it keeps going, then you're just kind of securing profit at that point, right? But I kind of use this as a mental note. Like once it hits that, I set an alert and I say, okay, mental note to secure your profits up to this point or up to this point, right? So that if it retraces, you have no issue, right? Meaning closing half your lot sizes, meaning moving your stop loss up in profit, whatever it may be, closing half your entries, anything like that. You will not be caught off guard by a retrace because you would have secured most of your profit, right? So, um, in this situation, do you guys see how to place your stop loss and how to place your take profit? Now this is just on the 61.8 normal kill zone, right? That's just on this normal 61.8 normal kill zone. Now, what happens is sometimes what you're going to end up doing is it might break this zone, right? It might break that, and that's not a big issue, right? That's not a big issue. So what'll end up happening is, say you end up losing, say it ends up hitting your stop loss, and that's not an issue. That's fine, right? But what happens is you see it kind of weakening up here. You have this secondary kill zone, which then you'd move up your entry, like right. Say you entered right here at the beginning of your kill zone. You'd put your stop loss right behind it, slightly behind it, between the 886 and the 786, or you kind of put it between it, and it's going to be a little bit of a smaller stop loss, right? But it's going to be right in the middle, so that it'll give it a little bit of breathing space. And then if it goes through the 886, then you know that the trend has reversed, right? It hits that, and then it keeps going up. Rarely does it ever do this, right? Go all the way up here and then drop. Rarely. Does it happen? I mean, I haven't seen it, but sometimes, maybe. And then from there, what you would see is you would see that your risk to reward would be significantly higher because you're risking, 185 pips in this case. So it would be 18 pips, right? And then you would be using the same Fibonacci extension. So your first take profit would be all the way over here. And you see how that big of a take profit kind of and it goes along, and you're securing your profit as you go, right? You're securing half your lots. So, and that's kind of how to use your fibs. That's kind of how, like, the basic premise of how to use your fibs. Now, excuse me. Now, the next thing, and I discussed this with the one-on-one that I had just now, but I want to go back to it, and I want to kind of show you guys how to use it in this situation, right? So we're looking at Euro JPY, right? And we just called a signal for it, but I want you to kind of forget everything that's going on this week, and I just want you to look at the application of these fibs, right? When it comes to using Fibonacci, you have to realize that sometimes you're going to be looking at different places where you might have not looked at in the past, right? So, example, let's look at the 4-hour, right? Let's replay this. So let's go ahead and replay, and let's put it right here. Cool. Let's put it right here. How would you place your fibs here? What is the trend? The trend is downward, right? Since the trend is downward, you would put your fib up here, right? From up here, from swing high, right? From up here, swing high to swing low. Swing low. Watch where my cursor is. My swing low is down here. That's my swing low. Not here, this, right? It's from most recent to most recent, right? So it's kind of, there you go. From swing low to swing high. Sorry, from swing high to swing low, right? If it was an uptrend, right, it'd be the opposite. It'd be going from swing low to swing high, right? That's if it was an uptrend, right? So let's look at this. What happens in this situation? It's going up, right? It's going up. What would you do in this case, right? One of the qualifications for you to actually use your Fibonacci, one of the things that you should need to mark off your checklist, is the fact that you grab this, right, and you have to wait for that retrace. So you see it hitting the 38.2. And the 38.2, what Jim used to tell me is that the 38.2, right, is kind of a strong trend, right? If it rejects off of it, it's a strong trend, but this is also kind of like the first resistance, right? This is kind of like the first retracement point. Now, it can keep going through to the 50. The 50 is medium trend, right? But heavy, but equal buyers, right? Because there's kind of like equal buyers, equal sellers, right? So here there's more sellers than buyers. And in this situation, if it hits the 160.18, it's the strongest resistance, weakest trend, right? So let's look at this from our standpoint, where we kind of say, okay, if we wanted to enter this trade, would we enter right here that it broke past the 38.2 and closed above? Would we enter?
No, you would wait for a retest since it just broke it.
Right. Who was it?
Mustafa.
Yeah, exactly. So so you since it just broke it, you'd wait for a retest, right? So you wait for a retest, and what happened? Boom. What ends up happening? It jumps up more, right?
Sure.
It jumps up more, and if you would have entered here, your SL would have gotten violated, right? So what happens? You hit your entry right here, and at this point, you're saying, okay, well, it just blasted above. What do I do? You enter there, right? Because it's your primary kill zone, and you say, all right, well, I've entered my primary kill zone. Boom, boom, right? Awesome job. We've got a primary kill zone, not a big deal. Some people might say, okay, we'll fib it from up here to down there. Some people may do that, and that'll hit your secondary kill zone, right? But I prefer looking at the bigger picture with it. And so now you see how the 61.8 hits here, right? The 61.8 hits here, not a big deal. You enter here. You enter on a short position. So you enter where price is right now. Where do you put your stop loss? Anybody?
Structure.
Huh?
I don't really use this tool, but if I would have placed mine, it would be off of structure.
Off of structure? Okay. What part of your structure would you put it at?
Right there where it is with that 0.705.
At the 0.705? Okay. All right, that's a very large stop loss, right? At 88 pips. You know, so for swing traders, that's not a bad idea. For me, I know that, you know, as somebody who calls signals for other people, you kind of have to be considerate of other people, because imagine what a 0.01 is going to do to somebody's account if they have $40, if they have $50, right, at 88 pip loss. So being just a little bit, you know, considerate for other people's accounts, I would kind of have that, and I'd put it a little bit behind the 61.8, right around here, right, because it kind of had this zone right here. So I'd put it right around there at a 50 pip stop. Some people may be a little bit more conservative, and they might put it right at the 61.8. Personally, I'm going to put it right around here, you know, and we're going to have a little bit of a bigger stop loss right there. Not a big issue. Now, what happens is from there, what's our first take profit? Our first take profit is the 0. Boom, right? That's the first take profit. Now we enter, and let's see what happens. Does everybody understood why I did this? Everybody understand why I did this?
Yeah.
Okay. So it's just going on for, you know, a couple days. April 7th, we complete a week, and we're floating around in profit. Now it starts to dump. There you go. A little bit of consolidation. And from there, oh, there you go. Goes down, hits the 23.6 again, rejects off the 23.6, tries to hit it again, goes down, a consistent downtrend, right? By then, you'd be securing half your lot sizes, and there you go, TP1 hit. Now let's see what it does from here. So you've already hit your first take profit. Oh, second take profit wicked. And there we go. Now we're back at current days, right? Your second take profit got wicked. Now, what do you see here? What do you see that happened? Do you see the power of having, you know, an entry at the 61.8, having your stop loss, right? And then putting at this structure, right? Putting at the extension your first take profit and then your second take profit. Does everybody understand that? Does everybody understand how to do it?
Yeah.
Cool. Now that everybody understands how to do it, right? Let's look at another pair, and then let's see if we can fib it correctly. Go through it one more. Okay. What do you want me to go through specifically? Because there was a lot that we went over. Like, do you want me to go over like how to place it, how to use it? And here's something that I will never, ever, ever, ever recommend to you guys is trying to fib like a 15-minute or trying to fib like a 20-minute or something like that, and or sorry, a 5-minute or something like that, and trying to trade off of those time frames just solely using the fibs. You're gonna lose, and I'm not going to be sympathizing with you, because as you saw, I did it from the 4-hour. I didn't do it from the 5-minute. Okay, so that's kind of how to place for uptrend. Okay, give me 1 second. Let me look at the Discord real quick, and you guys are gonna come with me. Where are you guys? There you are. Share screen, Discord for the golden zone. There you go. So let's look at this. So you have to find an impulsive movement, right? This is a prime example of your impulsive movement. This is the beginning of an impulsive move, right? This is the beginning. Now you drag it all the way up, and I did this on MetaTrader, so it's kind of whack. But pretend this isn't here, right? Pretend from this candle on forward isn't here. Your top end of impulsive move is right here, right? So you put it from here to there. Now this isn't an uptrend, right? So it goes from here to here, meaning that you only expect more upside. So let's go in for a retrace. It hits your 61.8, your 50. You would have entered right around here. You would have put your stop loss back here. Boom, right? And you would have been in profit. So what happens is, do you guys see how to place that for an uptrend?
Yeah, thanks.
Yeah. So if we look at it, you know, in other pairs, let's say what do we want to look at?
Mind if I say something real quick, James?
Go ahead.
So I mean, you know, personally, I mean, I do like the fib. It's a great way to trade, but I think maybe James, you can go over price action in depth. I mean, I already know a lot about it, but personally, through my time of trading, once you learn to master price action and figure out, you know, what the candles are saying and all that kind of stuff, like that is literally the number one way. That and trend and, you know, major and minor support and resistance. That's, you know, that's mainly how I call my trades, to be honest. And I've found that ultimately is like one of the best ways to trade. And then the fib is just an added, it's a given, you know, it's a little bit extra, you know, of a view, pretty much is the way that I see it. And this is Hayden, by the way.
Yeah, so I see it a little bit of the opposite. I see that that Fibonacci is price action, right? Because you know, price action is really just the study of moving price, right? And I get what you're saying completely, but think about this, right? Whenever you see an impulsive move in a certain direction, right, it does have to retrace, right? So it's kind of like spraying a gun, right? So you run through your 30 rounds, you have to reload, right? So it has to go, and then it has to reload. It has to go, and now it has to reload, right? Since it has to reload, you're kind of staying in this position, and that's kind of why Mustafa called the trade, and that's why we're in profit right now, right? Because it has
Right.
to reload, and we're trading that reload. Should we? Not really, but you know, it was a profitable trade, and who doesn't want pips, right?
Right. Well, more or less what I was saying though, yeah, I understand that it is price action with the pullbacks and all that, but I mean, I was more leaning towards, you know, a lot of people that I've found both in my groups and other groups that I've been to, they don't really understand how to read the candles properly, if that makes sense. You know,
Yeah,
like and determining trend and support and resistance and all that kind of things, determining, you know, for instance, like reversals. Everyone asks about reversals, right? You
yeah.
know, it's really easy to find a reversal, you know, but a lot of people don't understand the higher highs, higher lows, lower highs, lower lows, and in terms of reversal and all that kind of thing. Like I've had quite a few people, like when we talk about that, they're like, what? You know, so I mean, that's more or less what I was trying to say, but
Yeah, no
you know.
problem. No problem. Yeah, I'll go over that in a class after this, but I was focusing this one mainly on Fibonacci because I had a lot of questions on how to use the fibs. But yeah, I already have a video on that, a recorded class on that. And if you guys look at the Discord, you guys will have everything up here. When it comes to Japanese candlesticks, you guys will have all of my preferred candlesticks and how to read one, how to use them, and how to kind of spot them, right? That's how to trade them as well. That's in module 2. So like I go in depth on how to actually trade them, meaning that like, you know, this is a pin bar. How do you trade the pin bar? How do you use it, right? So you have this pin bar here, you have the demand zone, you have this, and how do you trade it, right?
You should let me hop in that Discord.
The link is in the channel.
Oh,
Um,
is it?
yeah. So what happens is going back to fibs, right? Say we go to GBP USD, right? And this is something that Jim used actually to call that giant drop on GBP USD because he was using a fib on the weekly. What is this? Can you go over Confluence? I have a video on that. I'll send it to you. Confluence, again, many people have been asking. Confluence, multiple time frame confluence is the exact same thing. Multiple time frame confluence is just going from top to bottom. And are you in the Discord, ma'am? If you're in the Discord, you just need to go to the classes, and you'll find multiple time frame confluence. You'll find time frame class. Where is it? I already had a recorded Fibonacci, but I wanted to make another one. and you'll have time frames. Yeah, that one. You have two classes there that you could look at when it comes to multiple time frame confluence. Yes, ma'am. So going back to fibs, when you see this, right? When you see this, what is the trend?
Down.
The trend is down, right? The trend is down. So when you see this giant drop, right? When you see this giant drop, how did we predict this? Let's go back. Let's replay, and then let's bring it back up to here, right? Let's bring it back up to there. So what do we see? What do we see? We see a little zone that never broke, right? We saw, I don't know why I put that there, but apparently I put that there. So let's put it from up here, right? That wick up here. And let's do it from swing low to swing high. What do we see? We see a retrace to the 38.2. And this is where multiple time frame confluence comes in handy, right? This is where multiple time frame confluence comes in handy. Because if you would have dropped to the 4 hour, oh boy, and we didn't, the replay messes up. Okay. Give me a second. Replay right there. Well, if you would have looked at the multiple time frame confluence at the beginning, right, you would have seen that it was getting weak, right? It was getting weak in the lower time frames, and it was kind of starting to slow down. And you would have gotten a nice entry somewhere around here, right, with your stop loss right at the 50. So it's just kind of like using the fib lines, meaning that like if you enter off the 38.2, fine, not a big deal. You see a clear downtrend here, right? But the problem is that your stop loss would have to be right at the 50 or a little bit below a little bit above the 50, and that's kind of risky because the market likes to take those 50 levels. But say you would have entered, say we go a little bit even more back in time, right? Say we even go a little bit more back in time, and we bring it all the way back up to here, right? Let's say we bring it back up to here, and now our fibs are a little bit different. Our fibs are a little bit different, right? You could swing it down here if you'd like. You could swing it down there if you'd like. I know that Jim's going to yell at me, but it's going to be right around here, right? You see that the 38.2 kind of jumps in right here. You'd enter, right? You'd enter because of that rejection of the 38.2. So your position would be something like this. Say we've entered right around there. Say we've entered right around there. Our stop loss would be where? Right at the 50. Almost an 100 pip stop. So I'm going to be lowering it a little bit more to around there. Yeah, I'll leave it right at the 50. Why not? And then from there, what's our first take profit? Our first take profit's right here, right? But I'm going to leave it out to my full take profit, which I always trade with TP3 in my head, right? And then we see what happens. Let's see what happens. Oh boy. There you go. See why it's important to have your structure set? It went really close to stop loss. Hey, and there we go. And that's your first, second, and third take profit hit. And then it just dropped off the face of the earth. But that's fine, right? Because here in this case, you would have been doing what? All the way through. And that's kind of why you put your stop loss back here at the 50, right? Because if you would have set it right here, you would have kind of gotten caught. You would have gotten caught out, right? You would have gotten caught out. That's kind of why you keep it on structure. But that's also a good another entry that you could have entered right here, right? And let's exit out of the replay. Right, you could have waited for another entry, because the market, what does it like to do? What the market loves to do is the market loves to retrace. And if it loves to retrace, what is it going to do? Most of the time, it's going to go back to your entry. And that's kind of the skill that you have to develop, meaning you kind of have to develop your sense of, I see the market retracing, what am I going to do here, right? And oh boy, that's not good. Let's do it off the daily. So in this case, right, your take profit would have been hit, right? But what would have happened? You would have put it from here to here, right? Again, your fibs. Swing low, sorry, swing high to swing low. And you could have entered again right here. Not a big deal. You could have entered again right here because you knew that this wasn't like breaking out anywhere. You could have entered right here. True. But you wouldn't have really had a very good entry, right? Because the 38.2 isn't exactly a very good entry, right? The best entries are at the 50. The best entries are at the 61.8. Those are the best entries.
That
Meaning
kind of almost looks like a distribution phase in a sense.
exactly,
Like
because it's
going
acquiring
sideways.
liquidity, and this is something that Jim used to always tell me. Whenever it's doing this, is because the banks are about to make a big move. It's kind of like coil coming together, right? It's kind of like a coil or a spring crunching down on itself, right? Because it's acquiring liquidity. The banks can't move the market like this in one move, right? They have to kind of amass liquidity. They have to amass money over a certain amount of time, and that's exactly why they just kind of go up, down, up, down, up, down, up, down, because they're like, yes, we're going to trade very easily today. We're going to pop, 100 standards right on here, and then we're going to drop it all the way here. We have our set take profit, and boom. Now we're going to buy 100 lots, and now we're going to sell 100 lots, and now we're going to buy, now we're going to sell, now we're going to buy, now we're going to sell. It is very easy for them to communicate, right? But what happens? As soon as you see this amass in liquidity and you see this hit the 50, you're like, I am going to enter there. Thank you. I appreciate it. Your first take profit gets hit, and then you secure your entry. Your stop loss and profit gets hit. It comes back up to the 50 again. You enter again, right? Same thing, same position. And at that point, this would have fallen off the face of the earth. You would have been very happy. TP 1, 2, 3, and 4 got hit, right? All of the extensions got taken out, which means what? That would have been an extremely profitable trade because you would have held through, how much is this?
Damn, and that's on the daily too.
That's on the
That's a
daily. Yep.
pop.
From the daily,
Wow.
that would have been around what? 1,600 pips?
What pair is that?
GU.
Oh,
Yeah, it just happened, bro. It happened like 2 weeks ago. uh yeah, it has to build momentum and liquidity, and because it has to build momentum and liquidity, you won't always. That's why a lot of people don't like trading forex, is because they don't have the patience for it. They're like, oh, it's so slow, I can't have $1,000,000 today, I'm gonna cry no, stop.
I
eventually you
was
get
told something.
eventually
Sorry.
eventually you're gonna get, these big moves eventually, right? You can't get them immediately. Will you? You will get them at one point, right? You will catch this at one point, but you just won't do it if you're not careful enough. Another pair that I see that's building a lot of liquidity right now is GBP/JPY. Look at pairs that are oscillating. Look at pairs that are kind of consolidating. CAD/JPY is also consolidating a lot, right? If we look on the daily, we just kind of see it making this little right here. It could be forming a head and shoulders, and boom, that's going to fall off the face of the earth. But then right here, we're going to see it, and we're going to say, oh, double bottom. Let's see what it does. Then it'll probably buy all the way up, and then it's going to shoot, right? So as the GBP also gains more strength, we'll see that, come in handy as well. That's how to use your fibs, guys. That's how to use your fibs to make your profit, right? Again, price action does have a lot to do with this. Supply and demand zones do have a lot to do with this. I don't use support and resistance lines because lines are kind of useless in a market that's liquid. It's better to use zones, right? It's better to use zones that kind of give you a proximal and a dismal line. And this is where I explain it, right? I explain it intro to supply and demand. I explain the distal and the proximal line, right? And
Hey,
this,
James,
what's up?
what's your view on imbalances? Like, I don't know if you've ever heard of smart money, but they talk a lot about like
Wick
imbalances.
imbalance, wick imbalance.
Yeah, pretty much how there's like right there's a bunch of bearish candles all the way down.
Yeah.
So it has to go up to fill that pretty much.
So that's kind of unless you really show me, hey, I can continue rising, and I will, I'll like, so like for example, say we have a swing low to swing high, right? swing high to swing low. No, swing low to swing high, right? So we go up, right? Say we do that. The meeting's about to end, guys. This is the end of the lesson, but I'll start another one, and we can keep talking, okay? That cool with everyone? Thank you for all the 13 that showed up, and I expected many more of you guys, but I guess some of you couldn't make it. But I appreciate you guys coming. I'm gonna restart the call, and I'm gonna make sure you guys get a little bit more information.
Yes, sir.